Hi and welcome to another video on this channel. Today we will talk about the major events in the financial markets 2024, and even more importantly, we will also talk about the chances and risk for 2025. Today's discussion is with Chris Schenk and the founder of Das Family Office, Mario. Hi everybody.
Hello. Good afternoon. Good morning. Okay, so for regular visitors of our channel, you will find a slight difference in our format. I actually felt that it's a bit boring if I always reflect on what's happened, and I want you to see that we're working with a very dynamic team, with Antonia and Chris, and most of all Isheng, who's really the most reliable person in our organization here in Singapore. So I hope you will appreciate that we have a more Q&A format, and I think it makes a bit more sense, and I hope you like it. Please also send us questions and ideas how we can improve going forward.
Okay, so Mario, in the quarterly reflections or the current quarterly reflections, you mentioned that 2024 was one of the best years for the financial markets. But what made 2024 such a successful year for investors?
Yeah, 2024 was effectively a second year running with very high double-digit returns. Depending on which market you were investing in, you could see really high returns in global technology markets, specifically anything related to the Nasdaq 100, as well as the so-called Magnificent Seven stocks. That is Amazon, Alphabet, Nvidia, Microsoft, Meta, and Tesla. Oh, I forgot Apple, and also Apple. And these stocks have been driving the major indices, most of all the Nasdaq 100 index, but also the S&P 500 index, as well as the MSCI World Index. All of these indices now have a massive weighting to technology. In some cases, this exceeds 30%. And yeah, I guess I can say that the whole world has very high confidence that these companies are here for good, that they're doing very well. And indeed, they do. Although I would argue that we've reached a point where valuations are very high, and people should be careful, or investors should be careful to expect such returns on a forward-looking basis. Everything has a price, and we may be reaching the high price. But to answer your question, we had 2 great years in a row. The last time we've seen that, or typically we see such strong market developments only in the aftermath of a brutal correction, such as COVID or the global financial crisis. I do remember that we had similar markets in the late 1990s. That was also when the internet was driving market dynamics. But yeah, it's remarkable. It's been a great year, and actually a great 2 years. And if I look at our client portfolios, they're indeed looking very well, because we're advocating global allocations, and most of our investors have benefited from these trends. I'm really excited.
One big event last year was also Trump's re-election. And now my question is, what do you think are the potential effects on the financial market depending on Trump's policies and agenda for the next years? How will this impact the financial markets?
Well, the good thing is he's been president before, so we have certain ideas what could happen because we know what happened at the time. I think it's probably not wrong to say that this year will become much more volatile than this past year, as well as 2023. Volatility will certainly be a big part of 2025. That's not to say that markets will have to be selling off or there has to be a major crash. It just means that Donald Trump will always come out with certain statements that will move markets. I guess this time around, many people will be a bit more prepared for this. So the market responses maybe not as dramatic as we've partially seen it in his previous presidency. Um, and obviously, we know what he stands for. The good thing is, from an equity investor perspective, is he likes to be measured against the U.S. equity markets. So we could already see towards the end of last year and early this year, when inflation was a big discussion topic, and when long dated bonds moved higher, They were quick in coming out that the tariff campaign will be done a bit slower, certainly to calm down the market. And this is quite unique to Trump, I would say. I don't recall any other president that would measure himself or herself against the stock market. So that's fundamentally good news for investors in US equities. And we also think that US small company stocks should benefit because they're valued at much lower levels than, let's say, the Magnificent Seven. So US equities should benefit, and we started talking also about the so-called S&P 500 equal weight index, because if we're looking at this index, it's currently valued at about 17 times earnings vis-a-vis 22 times earnings for the version of the S&P 500 index that's calculated based on market capitalization. So clearly, US should be a market to not ignore in 2025. Um, Other obvious winners are not so clear, in all honesty, because the rest of the world will have to deal with the various tariff announcements, what that really means, whether tariffs will really be established or not, and to what degree they will be established. At the same time, there are great companies globally. We've seen this yesterday where European luxury stocks did very well because Richemont announced great earnings that showed that the luxury sector isn't dead, and many of these luxury stocks are in Europe. So it's not all bad for the world outside the US, but we have to be selective. Um, I would probably go with active management strategies in Asia as well as in Europe, because the broad indices may not benefit to the degree that individual opportunities may benefit. And at the same time, talking about Germany, a country we're all very familiar with, there's an election in February, and with this, in case this election will bring about a stable coalition and stable government, this could in fact help Europe. And Europe is currently a bit underappreciated for many reasons, and probably also for the right reasons. But if the war in Ukraine could come to an end, and there could be a stable government in Germany, Europe may actually do quite well, and the currency is cheap. So there may be opportunities. But yeah, we have to wait for this election to happen. As far as Asia goes, I think it's quite known that China is the biggest competitor to the United States, and will and that's why I assume that Chinese stocks will have a hard time. But at the same time, Chinese stocks have had a hard time because the government made so many mistakes, and the government is not really interested in stabilizing the economy in a way that it would benefit entrepreneurs. That's why, with or without Donald Trump, Chinese equities don't strike me as a very good idea, even if valuations are very low. Then other countries that should benefit, clearly residing in Singapore here, Southeast Asia, ASEAN countries should normally benefit because they're neither China, they're nor the America, nor the United States of America. So I would imagine that there will be winners in ASEAN and India also. India is a market that was hyped in the last 2 years, probably too much, and it still appears pretty expensive. But once the current correction comes to an end and we see lower valuations, this may actually be a good entry point. And long-term Indian equities could complement US equities and quality companies globally quite well. So we like this in client portfolios. But Trump will bring about volatility. Volatility will be higher in 2025. I mean, I don't like predictions, but I think that's a prediction I'm quite comfortable.
Mario, on the topic of inflation, I think in the past few months we've seen higher than expected inflation numbers, but I think the number that came out yesterday or 2 days ago was more or less in line with expectations. Do you see any upside risk to inflation next year going forward, or is there any risk for inflation getting stuck above 2%, such as 2.5% or 3%? And do you also think that the Fed, who is shown to be a bit more accommodating to markets, how would this pan out for both bonds and equities going forward?
Yeah, I do agree. Inflation is something we need to watch, and I actually, I mean, in all honesty, it was very good that 2 days ago that the core inflation in the US came down, because there was a fair bit of fear that that inflation has already bottomed and may move up again, and may force the Fed's hand, i.e., increase interest rates again, which would really be a big problem because global equities, or not global equities, but U.S. equities are expensive, and if the interest-free rate moves up, the risk-free rate moves up again, this will be a problem. Um, yes, the core inflation rate has now come down. It's now annualized below 3%, which is very good news. But 3% is not 2%, and the U.S. debt is very high, and the fact that tariffs may be established to a large degree. This will also make products more expensive in the U.S. And I'm not sure if deflationary trends out of China can counter this sufficiently. I wouldn't be surprised if the new equilibrium for US inflation could be above 2%, maybe somewhere between 2.5 and 3%. If we're looking at the TIPS, Treasury inflation protected treasuries, it points to inflation expectations of about 2.5 to 2.75%. That may be the new inflation equilibrium, and this is, I mean, on one hand, the good news is, if that's the medium-term inflation rate, and we're currently getting 4.25, or even up to 6% on floating rate notes, we're actually getting compensated for higher inflation. We see real interest rates, but we need to watch the inflation, and we also need the U.S. debt situation. This will also be a big part of the discussion in 2025. Is Trump going to increase the debt further? I mean, in a major dramatic action, or will he be contained, and the U.S. debt will in fact stabilize? We need to observe that. This is why I would actually recommend to be careful with long-dated U.S. Treasuries, even if you now get close to 5% for a 30-year Treasury, or 4.7 for a 10-year Treasury. This may not be enough to compensate you for an erratic presidency and high US debt. So I'd be very careful, and would rather focus on fixed income niche segments. Let's call it this way. I prefer the short end because we still get 6% for floating rate notes and 4.25 for US Treasuries. But even if I look at Asian high yield, I think the Asian high yield market has stabilized. We're looking at emerging market high yield, which have stabilized. Actually, they've performed very well in 24, but I think valuations are still very attractive. So this should do quite well in this environment. The same goes for tier one capital and preferred capital. So I think we should focus our fixed income allocation to short to medium duration, as well as these fixed income specialty markets. I'd be careful with the long end of the US yield curve. In fact, actually, we have our skyscraper chart, which we will show. This shows quite clearly that certain equity markets, such as S&P 500, World Quality Equities, Nasdaq 100, and the MSCI World Momentum, are quite expensive. We see risk premia that are way below 6%. In the long term, we expect at least 6 to 8% for a broadly diversified equity exposure. At the moment, we see much more attractive valuations in these fixed income segments. We can expect risk premia which are in many cases higher than equity risk premia. So focusing some of the portfolio away from these expensive technology stocks into some of these attractively valued fixed income segments could be a nice way to achieve high returns, and diversify the portfolio a little bit away from the Magnificent Seven and some of these tech darlings.
In that regard, do you still see as the 60/40 portfolio still doing well in the next 2 to 3 years?
I do, actually. In fact, it may be a renaissance of the 60/40 portfolio, because the 60/40 portfolio suffered specifically because of the low interest rates, because equity valuations, let's say 4 or 5 years ago, were reasonable. Let's call it this way, but fixed income markets were excessively expensive. Now we see not exactly the opposite, but we see comparatively attractively or cheaply valued fixed income markets and to a certain degree ambitiously valued equity markets. But if we look at equity markets in a very diversified fashion, we're using these dimensional world allocation portfolios as benchmarks. They have up to 13,000 stocks, and the Magnificent Seven are effectively just about 10% of this overall portfolio. If you look at the MSCI World, you have about 20 plus percent Magnificent Seven allocation. So if I just look at a portfolio combination of dimensional world allocation with a decent fixed income building block, we have a nice portfolio. So 60/40 is I think a good starting point for many investors.
I think in the past you have previously been more skeptical of private assets such as private equity and venture capital, but I think 2024 you've also um, delved more into certain private equity funds and VC funds, especially with the VenCap 18 fund that we've recently helped to promote in Singapore. Is this a result of your change in investment philosophy, or is it more of client demand that has changed this allocation focus?
Yeah, that's a good question. Um, I'm still very skeptical on private assets. This hasn't gone away, but it's also our responsibility to be the trusted partner of our clients. And we have had more clients who were inquiring about private debt, leveraged buyout, and venture capital. So obviously we've done what we need to do. We've started to go deeper into our research. And whilst similar to our findings on actively managed mutual funds, we see that the bulk of the product offering is uninspiring, is not something we would want to see in client portfolios. But I would honestly say that we've seen some really good solutions in the leveraged buyout space, in the venture capital space. Otherwise, we would have never promoted the VenCup portfolio, um, even in private credit. So I would say, let's say Hamilton Lane and Harbour West have become part of our core discussion items with clients for leverage buyout and venture capital. VenCap obviously for high quality venture capital access, and for private credit we have several solutions. What I actually always liked about private capital is the fact that they only have quarterly NAVs. That means you don't really see the market volatility as much. Obviously, you could argue you're hiding the true volatility of an investment instrument, but for some personalities, it's actually good if they don't see how their portfolio moves so dramatically, because ultimately they want to hold their investments for several years, and so putting certain amount of money into private assets can be a good idea for the very emotional of our clients, and you know that we've done this for some of our more emotional clients. But even if somebody is less emotional, I'd be very comfortable with putting some money now into leverage buyout, venture capital, and and also private debt, because the valuations are much lower. Just yesterday, we attended the conference call with Preqin. Um, Private markets have done much worse. Let's say if we're looking at the equity strategies, leverage buyout, and venture capital, they've done much worse than public markets. And the result of that is that valuations are not elevated. In fact, they very attractive in certain segments. Also, the secondary market leverage buyout offerings that we've seen point to attractive entry points. And this is important. We want to start investing when valuations are low and not when valuations are high. So I could imagine to put some of the well-performing building blocks, shave some of that off, and putting into to some of the leverage buyout ideas that we have. I mean the ones that I mentioned. And private credit the same. I think they're a good complement to the high yield managers that we have, and so I do foresee that we will identify one or the other great idea in the private capital space this year. But we will never be somebody who runs around and tells affluent investors and wealthy individuals that they have to over allocate to private assets. That's something we will never do.
What do you think is like a share that you would say you should invest in that private equity market?
The good thing, we have established our fair horizon concept where we effectively looking to map investment ideas with investment time horizons. And we've mapped leveraged buyout and venture capital as dark red. And dark red for us means investment periods of at least 15 years. And for private credit, we're working with the color yellow, which means investment time horizon of 7 to 10 years. So these would be the preconditions to put any of these ideas into an investment portfolio. So it has to be clear to an investor that this is not something we would ever trade. This is something we would hold for the long term, or for these periods at least. And obviously, things change. Investment time horizons change, which also means you shouldn't put too much of your money into illiquid investments, because if you think you have a time horizon of 10 years and that changes, and your time horizon is much shorter, all of a sudden you need to be flexible. And this is why most of the vehicles we're currently looking at are reasonably flexible. They can be redeemed to a certain degree, which is important. But some of the vehicles that we've looked at, such as VanCap 18, this is not redeemable. This will have to be kept for 10 to 15 years, or at least the exposure will not end for 10 to 15 years. That's something where I would say 10% is potentially the maximum allocation we'd currently be looking at.
Yeah, as like in this episode, we always share a lot of information for people who are already invested. But as the beginning of the year is always a good start, what kind of advice would you give someone who wants to start investing now?
Yeah, that's also a good question, because this question points towards the idea or the ambition to time the markets. We have this question time and again. Prospects approach us and say they have money to invest, or especially now somebody who may not be in the markets, who may be a bit envious to see how equity markets have done so well in the US, and people would like to participate. There are two elements to this question. One is market timing as such doesn't work. So time in market is more important than timing the market. And this statement has proven to be right time and again. And Ishang actually has done a lot of work on what we call, somebody who's been very lucky to always invest at the low point, somebody who was very unlucky to always invest at the highest point of a market, and somebody who is very strategic, who always invested at the beginning of a year. And the result is that long-term performance, or the long-term returns of these three different approaches or three different situations, is not very different. So the academic work will always point to, don't bother, just invest according to your target allocation, and as far as we're concerned, according to your target fair horizons. But then there's also the human aspect, and I can honestly say it is frustrating if you move to target allocation immediately, and then you have to go down. And we've seen this with certain clients in late 2021. Markets were comparatively expensive. They still wanted to invest, and we also more or less said the same at the time. Don't bother with market timing. But then, unfortunately, in 2022, we had a significant bond crash, actually a historic bond crash, which brought the fixed income markets down by more than 15% in many cases, and equity markets 20% plus in the negative, which is why we can't also ignore this human element. And if we're following this, or let's say if we're looking for an ideal solution somewhere in between, so it's probably best to move to target allocation fast. Don't wait up. So first buy the investment components that are reasonably valued or cheaply valued, and hold off with investing in the building blocks that you really like. In our case, this would now be maybe the Nasdaq 100 or certain tech stocks, or our quality managers that predominantly invest in quality stocks. And as we also know, markets will always present correction opportunities. We've seen this in August last year with the Japan crash. There will always be times when markets don't do well, and then you should use, let's say, you imagine to have a certain amount of money in that preferred sector, but you only buy it once you have a correction. And since we know that global equities are currently not expensive, we could start with, let's say, dimensional building blocks or the really broadly diversified MSCI all country investable market index building blocks, so that we are not over allocating into the tech segments. But if Donald Trump comes up with a statement that confuses the market, and the market sells off, then buy some of these Magnificent Seven ideas. But being in the market is important, especially for the people who really can't make up their mind to invest. I've been talking to certain people sometimes for years, and they can't get themselves to invest, and they're basically leaving money on the table. And yeah, and that's something we try to avoid.
Yeah, I think that is a great advice. And I would say we have actually reached now the end of this video. We discussed quite a few questions. You can find the link to the current reflections also in the video descriptions. There you find more or even more detailed information about the different funds and ETFs that the Das Family Office offers, as well as some example portfolios as well.
Yeah, for everybody who doesn't really know us and maybe sees this video for whichever reason, we're a Singapore-based multifamily office. We have a fund management license from MAS. And I think what makes us quite unique is the fact that we're a fee-only advisor. So we don't collect any retrocessions. We don't collect any fees from banks or product providers, service providers. We're the agents of our clients. The clients pay us, and in return, we give them best advice, help them to access whichever service they need at the best possible price. And we've been doing this since 2018. Yeah, we've received our license in March 2018, and we're an international team. Most of us are based in Singapore or in northern Germany, and it'd be great to work with you. So if you think we can add value to your financial situation, please reach out to us, and have a wonderful 2025. May the war in Ukraine end, and may Donald Trump be better for the world than some people expect. And all the best for you and your families.
Bye.
Bye bye.
Thanks.
Bye bye.